right, we'd like to welcome you guys to the 2020 year-end update on W-2 and 1099 reporting. The presenters today are Kate Sensel, Angie Ziegler, and Jillian Robinson. And we are coming in as presenting to you guys on the topics of payroll and W-2s first, and then Jillian's gonna close out our webinar today with the updates on 1099 reporting. So to say 2020 is like any other year is probably an understatement. We have lots of materials to be covering for you guys today. What we have in front of you for the agenda, this is on the payroll W-2 side of reporting. So what we're going to cover today is going to be our payroll updates. We're going to do quite a bit of talking about the COVID-19 reporting, preparing your business for year end, and then taxable fringe benefits, because it's always really important that we cover that taxable fringe benefits, because it's something that we do once a year that we want to make sure that that gets input correctly so that your W-2s are reporting correctly. So with the updates, we're going to cover some of our 2020, making sure that are you guys identifying these wage limits on your W-2s and also on your payroll forms, and then also sharing whatever we know about 2021 for any updates and changes, so that as we transition through December to January, that we are able to close the year out with this is the wage limits we need to be watching, but 2021 in January, we also need to be making sure that our computer software is set up to be able to calculate our first payroll in January correctly also. So the updates we have here, Social Security and Medicare, once again, we're seeing that increase in the Social Security wage base, 2020, 137,700, increasing in 2021 to 142,800. Making sure that when you're looking at your W-2s that you have an employee who is not over the 137,700. If it is over that, you will get an error on your W-2 reporting with the SSA, and then you will also have to amend not only your W-2, but also your 941 form if you have over-reported and over-withheld for your employees. There is no change to the Medicare tax rate, the dollar limits, and the additional Medicare tax. It's been similar like this for the past couple of years for the additional Medicare tax, and so no change on that information. The IRS has released the 2021 pension amounts. As you can see here, it's going to be a very easy year for us. There's no change. So 2020 and 2021, all of our limits are the same for between the 401k traditional, Roths, our simple plans, and also our catch-ups. What we also want to just make sure to point out is this is really important as you set up your software, is to know and identify what type of retirement plan you have, because you can see the difference between your retirement plan for 401k has a different limit than your simple. So if you are doing your 401k on your W-2, you should see box 12 code D. And if you're doing the Roth, it should be AA. If you are doing a simple plan, your W-2 box 12 code should be S. On our health savings account, we see a slight increase for 2021. So with our HSAs, we have self-only and then family limits. Very important that you are not going over these limits, because after that, it becomes taxable wages back to the employee, because they are only allowed to pre-tax up to $3,550 for 2020 for self and $7,100 for family. There is a catch-up also for the $1,000 if you're 55 and older. Now on the W-2 reporting for your HSAs, it would be box 12 code W. So you would report for code W for if you have employee pre-tax. So if the employee does after tax, you cannot put in code W. And then if the employer contributes, you also have to report that in box 12 code W. It is your choice on if you put 2 code Ws in box 12, or if you combine them and report the total of the employee and the employer portion. The one that we always wish that they would have an increase if anybody has children is the dependent care, but that has stayed strong at $5,000 every single year. I think since about dependent care came out, but we do see for flex spending that they are holding strong at this point with the $2,750 for between 2020 and 2021. I have heard some conversations that they are looking at increasing that, but at this point, from when we put this together, it was still at the $2,750. Now, for dependent care on reporting for the W-2, they have their own box for this. So make it sure it's very important that you set up this benefit correctly in your software because it needs to be in box 10 of your W-2. The flex spending, there is no spot on the W-2 that is requiring you to report flex spending. Some people put into box 14 just to have a notation in there, but box 14 is an information box. And we are going to cover a couple items now that this year that box 14 will be required to have in box 14 reporting. All right, so as we go through some more of these updates, here's just a couple other updates that you guys can have. For you guys, if you guys offer any type of qualified transportation fringe benefit, remaining the same. So $270 for 2020 and $270 for 2021. We're kind of seeing this happen with quite a few of these, seeing slight increases or just keeping it at, the same as 2020. Okay, so the 2020 Form W-4. So last year when we presented this same class, I think the biggest change that we were anticipating for 2020 was the big change of our W-4 form. But I guess we were taken for a surprise when we got to see what else was going to be changing for 2020. So one thing that we want to make sure that we're having a conversation about with the 2020 W-4 form is that, this got put into place last January. We have not seen the 2021 form be released, so we're not sure if there's any other changes or if it's just going to be very similar to this form. We want to make sure that you remember that you have to use the 2020 form if you have any new hires that are starting at your company, and that the only way that you can still remain with the 2019 or later form is if there's no change from your employees. So some of the things that we want to just kind of cover, this is very similar from last year, is that, do all employees have to fill out this new form? No, your employees, if they do not have any sort of change or update that needs to be submitted through on a W-4, they can still remain using their 2019 or later form that they had filled out. So, but anybody who started after January 1 is required to use the new form. Some of the things that, just point out is the steps that are required. So step 1 and step 5 are the two that are required that have to be filled out. The next slide will kind of go over the different steps of the form, but just want to make sure that you guys know that step 1 and 5 are required. The claiming exempt, like from the old form, there was actually a spot for that, but on the new form, there's not. So what they're telling us is that under the box 4C, in the open section, they just need to write exempt. Important that you guys make sure that if you have an exempt employee, that you have to get a new form every February 15th of the next year to make sure that they stay in exempt status. If they do not renew that exempt W-4, then you are required to put them at single zero. Does your software have to be able to operate with both W-4 forms? And that is yes. So throughout this whole year, you should have already been experiencing that, either having to select the 2019 or later, or the 2020 W-4, because it's drastically different on how that lays out. The question was, may I ask, all of my employees to fill out a new form? The answer is you can ask them to do it, but it is not required unless there's physically a change for that employee. The steps of the new form, so there is 5 steps. Step 1 is just getting the information, your employee's personal information. Step 2, this is accounting for multiple jobs. So are you going to withhold at a higher amount or a lower amount based on how if they check that box? And then step 3 is about claiming your dependents, a little bit more laid out like a tax, tax return, how many dependents do you have? And then also going into step 4 is making adjustments for any other type of income itemized deduction, which I said these ones are optional, but it does have a drastic change on how much you have withheld on the more information you fill out between step 2, 3, and 4. And the last slide I did say the only required steps are step 1 and step 5, and that's signing and dating it. The IRS did put out some good tools that were pretty helpful last year in getting us into 2020 with this new form. And those items still remain out on the IRS website. So the publication, we used to see in the Circular E, all the tax tables, but with the new tax W-4 form, they made a publication 15T for just the federal income tax tables. The IRS, they also have a webinar that you can watch to get some more information on the W-4 form itself. And then also there's a tax withholding estimator. So, a lot of people are used to having those allowances. I'm going to claim single 2, married 1. This is giving you more dollar amounts. And so for employee to understand what they're going to have withheld, they can go out to this this estimator and determine by how they fill out the form what will their withholding be on their paychecks. And then also I gave you guys just a sampling of the FAQs that were out there. There's a lot more out on the IRS website to show those FAQs. All right, so COVID-19 payroll reporting. So we're going to kind of go through a few of these updates. Things are coming in even late last week on how to report. We want to make sure that we're covering, this is going to be very specific to payroll and payroll tax returns and W-2 reporting. We could go into hours worth of COVID-19 instructions for you guys. The thing is, the government acted really quickly to try and get out some types of aid for business owners so that they can continue to pay their employees in midst of this pandemic. And with that, it meant business owners and most people had to try to implement and learn these different types of rules quickly. So what we're going to kind of go over with this is the Families First Coronavirus Response Act, which, if you hear me say FFCRA, that's going to be our qualified sick and leave pay to our employees. There's the CARES Act. There is 3 CARES Act, but we're not going to talk about the PPP today because there's no payroll reporting on a W-2 or a 941 in regards to PPP loans. But we are going to talk about the employee retention credit and also the employer tax deferral. And then we're also going to bring in the executive order for the employee tax deferral. So as we go through this, some of the words that, as we get calls and questions and consulting with all of our clients, the wording is very important because we will use the words exempt, credit, and deferral, and all 3 of them mean something different. Also on the 941, there's some verbiage in there that really kind of trip people up between refundable versus non-refundable credits. So, we're just going to really kind of dive into each one of these and talk about what's it going to look like as we come into the end of the year. All right, we're going to start with our FFCRA first. I don't know about you guys. I've never seen the 941 change so many times in 1 year. I want to knock on wood before I say this, but I'm really hopeful that we're going to come into 4th quarter with no changes and it's going to remain as what we use for 3rd quarter. So let's just hope I didn't jinx all of us. So with FFCRA wages, you had at the time you have to pay out your employees. So someone who there were 6 qualifications of how to pay out your employees if they either were exposed to COVID, sick with COVID, have a family member with COVID, out for daycare or school closing. So there was options 1 through 6, and based on how your employee selected which one they were out for, helped you as a payroll person either pay them at full rate of pay or at 2/3 rate of pay. So once you have paid out your employees, we have to report this now. So the 941, and also remember the 941 instructions is very important for that worksheet 1 calculation. So as you are reporting out the FFCRA wages, you've already paid them. When you pay out those FFCRA wages, they are exempt from employer Social Security tax. Just the employer Social Security tax is exempt. So that shouldn't even calculate. The credit, which will come down towards the bottom, is going to be against your FFCRA wages and your employer Medicare. We're really not going to talk a whole lot about the healthcare, but there is the credit can also bring in the healthcare cost for your employee and your employer, if the employee does pre-tax, what the daily average would be of the annual premium for your employees. There's a lot of calculation. There's a lot of things, and depending on what type of healthcare plan you have, that will decipher in more in general on that topic. But with the FFCRA wages, important that you have to identify separately your qualified sick wages and your qualified leave wages on the 941 in box 5AI and then 5AII. You cannot have these wages in box 5A. So when you go across on top of your 941, 5A is going to be your total Social Security taxable wages, excluding your FFCRA wages. And why this is important is because when you keep going across your 941 form, you're going to see that the 5A is timesing it by the employee and employer Social Security tax rate. but the 5AI and the II box is just the employee Social Security tax rate. So we just want to make sure we point that out for that 5A section. Then you'll file, if you're going to be taking the credit, and we're going to talk about the difference between some employers can pay out wages but cannot claim the credit. But if you're able to take the credit, worksheet 1 is very important for you, that you have to fill out step 1 and step 2. Step 1 is going to help you identify the employer's Social Security tax. This is important because this is going to help you understand, are you reporting in just line 11B, or are you reporting in 11B and 13C? So the non-refundable versus refundable. Don't let that scare you that non-refundable doesn't mean you're not getting refunded or you're not getting your credit. It's just basically what it's saying is, does the employer have enough Social Security tax to cover the credit? And if they do, it's going to be under 11B. But if they don't, whatever is over the employer Social Security amount is going to get dropped down to 13C. So that's basically what that part is about. So the ways to receive credit. So you can instantly get your credit on the FFCRA if you run your payroll and you figure out what your tax payment is, and then you reduce it by your credit of your FFCRA wages and your employer Medicare. Now remember, your Social Security tax for employers shouldn't be calculating because it's exempt, but if your software isn't up to date and it's still calculating, make sure you reduce the Social Security tax also. If you're doing the credit instantly against your EFTPS tax payment, when you file your 941, it should come out balanced. However, if you are doing your credit through either filing of the 7200 form or getting it on your 941 return, you're probably going to see a credit. You will see a credit on your 941 return if you're going to do it through your 941. The 7200, you have to make sure that you have submitted it before your 941 and that there's recognition that that payment's coming back to you. Otherwise, you cannot put that money on your 7200 line on the 941. The 7200 form has been a little questionable. I know it's supposed to be like a 2-week turnaround. We're hearing some get it, some don't. So just want to make sure you kind of point that out. Now, important with W-2 reporting, they just came out that any FFCRA wages have to be identified separately on box 14 for what was your qualified sick wages, what is your qualified sick wages at 2/3, and your qualified leave wages. So those have to be identified in box 14 of the W-2. The employee retention credit. So on the employee retention credit, you are going to see not so much anything happening with the payroll itself. This is all reporting on the 941. And if you want to be doing the credit earlier than the 941, filing of the 7200 form also for the employee retention credit. So the employee retention credit, this is going to allow employers, if they qualify, that they have 50% of wages paid from March 12th through December 31st, up to $10,000, 50% of that. So you can get a credit up to 5,000 employees, $5,000 per employee for the year, not by the quarter. So that was something that was kind of being tossed around a lot on if you get 10,000 every quarter. It's not that, it's annual. So the rules on this is that on your employee count. So they still had it be that if an employer averaged more than 100 employees during 2019, you can claim wages paid to employees who did not work but were compensated. So you paid them even though they were not in your office working or in your business working. And so you can get 50% of $10,000. However, if you're an employer that averaged 100 or fewer employees during 2019, you can claim wages paid to any employee during the time period that your business qualified for the ERC, the $5,000 per person. So it's something for you guys just to kind of think about the employee retention credit. Now, if you did take the PPP loan, you cannot do the ERC. Kind of the same thing as if you did the ERC, you can't do the PPP. So just so you guys kind of know, that's how that works out with the ERC. No W-2 reporting is required. It's just all being reported on the 941. All right, employer tax deferral. So now remember that we talked about exemption was with our Social Security tax for the FFCRA for employer. We have credit credits are both with FFCRA and with the ERC. Now we're going to be talking about deferral. It means that we're deferring the payment, but we're having to owe it back at a later time. So the employer payroll tax deferral allows the employer to defer the deposit and payment of the employer's share of Social Security tax through December 31st, 2020. So from current to December 31st. So with this, you are required to pay this back within 2 installments. You have 50% due on 12/31 and 50% on 2021 and 50% due or the remaining on December 31st, 2022. If you are wanting to pay this back anytime sooner than these 2 dates, all you have to do is log into EFTPS, make your tax payment applied to the right quarter, and that is how you pay it back. You do not have to do any other reporting on your 941. Once you make the payment, it's going to see that it's trued up and you're good to go. So I just want to make sure that also, this was before the 941 instructions actually came out, so nobody really knew how to do this the second quarter, but it came out on the instructions is that if you want to defer, but you already paid the tax in, you are no longer eligible to defer. So you cannot claim a credit on your 941 for the employer payroll tax deferral. You have to do it per payroll, deferring your tax payment at that time. So if you paid it in, you don't get to defer it. The 941 form also with this, you report this on line 13B. In second quarter, this is going to be one of the lines that changed from second quarter to third quarter. So I just want to kind of make sure we point that out to you guys. The executive order. So on August 8th, I believe it was, we got news of another payroll. I think this is what we're going to call the pandemic and payroll, because these are all quite, hitting payroll, different types of forms and paychecks and all this good stuff that we're having to deal with. But this one came out, and it came out pretty fast into the way that we got notified of it, and we had lots of questions, but we didn't have answers. This resulted in many employers opting out because it ended up being very time consuming for an employer, and also could be very costly to an employer to implement this employee tax deferral. So what this order is allowing the employee to now defer their portion of Social Security tax from September 1st to December 31st, with it being required to be paid back by the employee by April 30th, 2021. At this point, this is what the employee tax deferral is about. Now there's speculations on, is that going to be not have to pay back next year? We haven't received any information on that. But as we know it today, this is what the employee tax deferral is. Same thing with the employer, is that if you withhold it and then you pay it, it is no longer eligible to be deferred. There was, lots of different limits that were put on this too, about having to watch every single paycheck, that if an employee went over a specific dollar amount per payroll, then they were not eligible to be able to defer. But on the next paycheck, if they went below that limit, then they could. So like I said, very time consuming trying to operate this employee tax deferral. However, if you did do this, the 941, you are going to report this deferral with the employer deferral if you did both on line 13B, and then you have to separately report just the employee portion on line 24. Now remember, second quarter and third quarter, line 13B and line 24 say different things. So make sure when you are filing any of your returns, hopefully all your second and third quarters are done. But if you are having to do any type of amended, that you have the right form. So that's something just for you guys to think about on the employee tax deferral. Also with this, we just found out, it was a little surprising to see how they're having the W-2 reporting on this. So if you participated in the executive order, you will not report in box 4 the amount you deferred, but you will report in box 3 and 7, if 7 is for tips, Social Security tips, but you will report in box 3 and 7 the wages, the total wages. So if you're someone who ties out going across your W-2, it will not tie, because box 4 is missing the part that you deferred. Now what happens in 2021 at this point, that if or when your employee pays back this tax deferral, they are now requiring you to go back to 2020, file a W-2C to correct box 4 to make it be the actual tax amount. So we're going to kind of keep watching for more guidance on this, but this could be also a lot of work having to go back into 2020 to do W-2Cs to fix these employee tax deferral. We want to just kind of throw out here something real quick about government employers, because we kind of talk a lot about like what the CARES credits are in the FFCRA. Now here's one of those that if you're a government employer, that you can participate in some of these you can't, but you can participate in these benefits that the government put out there. However, you can't fully take a credit on it. So with FFCRA wages, we just want to point out that you can pay them. You can exempt yourself from the Social Security tax for employer, but you're not allowed to take the credit. So you won't be filling out anything on the 941 in box 11B or 13C, just the Social Security tax credit. The ERC, you are not eligible to participate in the ERC, but you can participate in the payroll tax deferral. A lot of this is the same information that you have on the previous slides. So I just want to kind of point that out to you. And then also the executive order, same thing. You can take part in the executive order and then the payback for 2021, but you cannot take the credit. Okay, so I know I just kind of threw a lot of you guys at with the COVID stuff. I know we got some great resources also out on our Eide Bailly website, and we've been putting out a lot of information on the COVID reporting between, including with the PPP stuff. So I would recommend going out there to see some of the materials that we have out there for you guys. All right, so we're going to kind of talk about developing a year-end plan. So some of the things that we have to do as we prepare coming into the end of the year is making sure that we have a checklist and we have reconciliations. So throughout the whole year, what we don't want to be doing in January is trying to find maybe a payroll mistake that happened maybe first quarter. So as you guys go through, if you guys do your own or if you guys outsource it, this is something that we would recommend to anybody who's processing payroll, is that you reconcile quarter one, quarter two, your year to date. When you go into quarter three, you want to also make sure you reconcile your year to date again. So that when you come into fourth quarter, that you're really, timing it out, that quarter four is ready to go so you can go right into your W-2s. Now, here's just a quick sample of something that we're talking about for reconciliation for you to reconcile between your taxable wages and your withholdings. For both federal and for state. And don't forget some of your local taxes either. So we want to make sure that you guys don't forget some of those taxes that maybe is specific to your state. Everything we cover here is basically federal, but I just want to throw a few key points in for those states. With payroll, I mean, the nice thing is at the end of the year, you should be able to put a nice bow on your W-3 and be like, all right, the whole year's tied out. Now start on to the next year. So kind of coming into, you start with your payrolls, you go into your tax payments, your quarterly returns, always your W-3s. Everything should reconcile and tie out, becoming at the end of the year. Something just kind of show you guys just an example for taxable wages, because we all get that question. Gross wages versus taxable wages, that an employee looks at their paycheck at the end of the year and they see that their dollar amount is higher than what we reported on the W-2. And we want to make sure that we can explain to them how the taxable wage is different than gross wages. Here's just a quick, some of the easier things, not obviously adding into all the taxable fringe benefits that Kate's going to be talking about. But we just want to show you that gross wages is, your rate times your hours gross. But on your W-2 reporting, that we take into consideration your pre-tax plans, your retirement plans, and how does that foot out down on your W-2. So just kind of give you guys an example of what that looks like. And then also, we wanted just to kind of give you guys some talk about how do you guys prepare for the end of the year? What do we need to put in place to get us ready for that final paycheck of December and moving into the first paycheck of January? Because there's a lot that happens in between that time frame. So some of the things that we put out here, we kind of just did a quick chart for you guys from October, November, December, and January. Some of the key things that we want to talk to you guys about in October is, making sure you're ordering your forms. Do you need to order W-2s, 1099s, your envelopes? Some of the big things that are really being talked about right now is the 27 pay periods. We are going to be facing that because with the end of the year, January 1 being on a Friday, we know that's a bank holiday. If someone moves their paycheck back to December 31st versus moving it forward to the next Monday, count your paychecks. How many paychecks do you have in that year? Because you may have a problem that if you over-report any of your pre-tax that have a wage limit, then you will be over-reporting. So I would encourage anybody to go look at their paychecks, or if they're in charge of benefits, just to make sure that you have this figured out. This is also for salary. I mean, this hourly, it's not an issue for hourly employees because they're paid the hours they work on the pay period that you've established. Salary, however, usually you take your annual salary divided by, 52 weeks, if you're a weekly payroll, or 26 if you're biweekly. Well, now if you actually have 27 payrolls this year, that's going to overstate your budget for salary. Garnishments also, they think of a child support garnishment, that if you have it set up for a biweekly and then you now have 27 payrolls, this could also overstate how many payments you're coming in to that year with. Benefits, like I said, dependent care is a great example. You take $5,000 divided by 26, and if you end up having a 27th payroll for this year, you are going to be overstating that dependent care, which will become taxable wages to your employee. So make sure you're watching for that 27th payroll. It happens about every 6-7 years. It happens to most businesses. So this is going to be one of those years that it's going to trigger it either this year or next year because of how the year end falls. So be watchful of that. Also make sure that you are getting ready for your taxable fringe benefits. So you're going to start accounting for them so that you can get them put on the paychecks. Kate's going to go over the calculation of those, but I just want to make sure that we touch base on that we have to at least have them in once a year. So get yourself ready for that. We also want to make sure that we're getting information for next year. So attending a class like this so that you guys are aware of what wage limits need to be updated. Contacting your accounts payable department for any type of a check that they wrote out to an employee, determine, do we need to get that on their W-2? Moving allowances was a big one because before it was a pre-tax, the AP would write out a check to that individual and it wouldn't be taxable. Well, now it is taxable. So now we need to make sure we get that information from your accounts payable department so you can put that on the employee's W-2. We kind of talked about the W-4 form, making sure that if it's exempt, you got to get a new one by February 15th. And then if you guys are doing the special accounting rule, we can start actually calculating out personal use of auto. So those are some of the things that you want to be thinking about between October and November. Now, December, January, which, January is tricky because it's the starting of the new year, but it's also getting your fourth quarter and W-2s prepared during the time frame of fourth quarter. So make sure that you're reporting your taxable fringe benefits before the last payroll of the year, determining what's your next year calendar. Do you have a 27 pay period next year? Determining what is the last check and the first check. Are your bank statements reconciled so that you can get your W-2s going? The other thing we want to make sure too is, a lot of people put on taxable fringe benefits at the end of the year and then they forget to make the tax payment because it's not in a normal payroll cycle. So don't forget to make your tax payments. As you come into January, just make sure your software is updated, make sure you're reconciling and getting your fourth quarter and your annual returns done. And then also know what your due dates are for this year, because this year with it, January 31st being on a weekend, we're going to be moving things to February 1st, so that making sure that you understand your due dates for your quarterlies, your annual returns, and your W-2s.
All right, thanks, Angie. So my section here is going to be kind of like just what Angie had talked about in the agenda. We're just going to kind of review our taxable fringe benefits that we talk about every year, but like she said, it's just a good reminder because we only usually do these once a year. So let's kind of get started with just what the basics first here. What exactly is gross income? So gross income is all income from whatever source unless it's excluded by law. So basically we're talking about all the income you earn before taxes and deductions. And some of this examples here that it would include would be money, property, services, meals, accommodation, stock, and as well as cash. So what is a taxable fringe benefit? It is a form of pay other than your employee's normal rate that is considered compensation. So within these taxable fringe benefits, what gets included in an employee's paycheck? It is the fair market value of the item less any amount the employee paid with after-tax dollars, less any amount that's excluded by law. Not everything is necessarily taxable to the employee, and this is what they would call a de minimis fringe benefit. De minimis fringe benefit is any property or service the value of which is so small that making accounting for it is unreasonable or administratively impractical. Many people try to assign a value to this, say like $25, $50, $75, and they think that anything under these amounts they would consider to be non-taxable to their employees. But of course, the IRS has never assigned a value to this. It would need to follow the definition in order for it to be non-taxable to your employees. So for example, some examples of de minimis fringe benefits are the occasional coffee and donuts that your office may bring in for your employees, the occasional happy hour or the occasional sporting event tickets. But obviously with COVID this year, not many fans are in attendance at sporting games, but we do get this question a lot, you know, if your company has season tickets and is holding a drawing to give tickets away to a certain game, is this taxable to the employee? It would not be, since it's an occasional item, and it would not, you know, have to be taxable to the employee. Now, let's say if the same person was using the season tickets for all the games, this would no longer be an occasional event, and it would no longer be de minimis and would become taxable to the employee. Also, the occasional meal that you may offer to your employees, for instance, if you have employees that are staying late, working a lot of overtime during like a busy season, this would be considered a de minimis fringe benefit and not taxable to the employees. But one thing to remember, though, that if you give an employee cash, the cash is always taxable to the employees, and this also would include like a gift card, which we'll talk about here shortly. With the fringed benefits, you can elect to handle these benefits as paid by pay period, monthly, quarterly, or at least you have at a minimum do it annually. Any fringe benefit in cash must be included income subject to withholdings, depositing, and reporting when paid. So to help with accounting for all the taxable fringe benefits, there is the option for what they call the special accounting rule, which is employers may elect to treat the value of a taxable non-cash fringe benefit provided in November and December as paid in the subsequent year, which we most commonly see this used when calculating the personal use of a company vehicle. But if you do choose the special accounting method, it must be used for all employees who receive the same benefit, and you must notify your employees that you're using this special rule. So once you've recorded the fringe benefit as taxable income to your employees, when are the taxes due? The taxes must be deposited for the same semi-weekly or monthly deposit period that you as the employer deem the fringe to be paid. So deposit the taxes using the deposit rules for that tax period. So let's say, for example, you're a semi-weekly depositor and you date all your taxable fringe benefits as of December 31st for this year, which this date happens to be a Thursday. And if you follow the weekly deposit rules, your tax payment will be due on Wednesday, January 6th. So loans to employees. What about these loans? Are these taxable to the employee? Just you have to remember, these are not advances. This is money that you have borrowed to your employee with plans for it to be paid back with the interest being charged. If the interest rate charged to the employee is below the federal interest rate, then the difference is taxable wages and put on the employee's W-2. So for example, here we see that you loaned your employee $20,000 with an interest rate of 2%. Well, the federal interest rate is 6%. So the difference between that is 4%. So if you take that times the $20,000 loan, it would be $800 income that we reported on the employee's W-2. But if you as the employer decide to forgive the debt, or for any other reason the employee is not expected to repay the loan, the entire balance of the loan becomes taxable wages to the employee in the year the debt is forgiven. So what about our 2% shareholder for S-Corps? Any amount the employer pays for the health insurance and the HSAs on behalf of the shareholder is taxable wages to the shareholder and reported on their W-2s. It is reported in boxes 1 and 16 with a memo in 14. It's not subject to Social Security and Medicare taxes, and you also do not have to withhold federal or state taxes on both these items. But you do want to make sure that this is visible in box 14. Some people have a lot of stuff that goes in box 14, but this is one thing that you want to make sure that is put on there, because there's only so many line items that are shown on your W-2, and they will need this when the shareholder goes to file their individual tax return. Their account will want to be able to see this dollar amount in box 14. For group term life insurance for a 2% shareholder, it is 100% taxable on the whole dollar amount. They do not get the first $50,000 tax-free like other employees, in which we will talk about the group term life insurance in just a couple slides down. Employer provided health coverage. Nothing has changed as in the past couple of years. If you filed fewer than 250 forms in 2019, you are not required to report it on your 2020 W-2 forms. The reporting is not required for an employee that doesn't have wages for the year and is only receiving healthcare benefits, nor is it required for an employee that was terminated and they have requested their W-2 early. But if you would be over that $250 employee threshold, you would report that in box 12 with the code DD. Third-party sick pay. This can be a great benefit for an employee, but it can be an administrative nightmare for payroll processors. The biggest question that needs to be determined is how are the disability checks being taxed? If the employer is paying the premiums, then the employees will be taxed on the wages when they go out on leave. If the employee is paying the premiums with after-tax dollars, then it's not taxable wages to the employee. The other item that you need to figure out between the employer and the third-party company is the reporting requirements. Who is doing what? Who's going to pay the taxes? And who's going to prepare the W-2s for these wages paid? If the third party is paying the employee's portion of the payroll taxes, then you as the employer are responsible for the employer portion. The tax depositing rules still apply to these payments as well. The third party will include the employee's portion of taxes on their 941 return, and then the employer will include their portion of the tax on their 941 return, which they file with the IRS. If the employer is preparing the W-2, then the third party will fill out Form 8922, which is the third party recap form. And this form is filed with the IRS and is used to reconcile for the year the difference between the 941 returns and the W-2s filed. If the third party is preparing the W-2s for the sick pay, then it's the employer's responsibility to prepare the Form 8922. The third party is not required to send their statements to employers until January 15th. So before you file your W-2s for this year, you want to make sure that you get your statements from the third party so that you make sure include all wages if necessary on the W-2s. Awards and prizes. So per the IRS regulations, prizes and awards given by an employer to an employee are generally taxable. Gift cards, this is always one that people don't think need to be taxed, but the answer to this is they are always taxable to the employee. It's kind of a funny thing came up to us, I don't know, within the past year or two. We had an employer come to us and said, if I want to give my employees a $30 gift card, but if I break it up into two $15 gift cards, then it won't be taxable to them, correct? Well, the answer to that is wrong. It doesn't matter what the dollar amount is, it's always taxable. Cash is cash. Company gifts given away, the amount that is taxable to the employee is the fair market value of the item if they were to go out and purchase it themselves, not necessarily what the company paid for the item. Some of these items could be donated to your company, so the company isn't necessarily paying anything for them. Safety awards and length of services. For these items to be not taxable, the award cannot exceed the following limits. For a non-qualified plan, total for both safety and length of service for any one person cannot exceed $400 in a calendar year. For a qualified plan, they cannot exceed $1,600 in a calendar year. And a plan is considered qualified if it does not discriminate in favor of highly compensated employees and is a written plan that has been put in place by the employer on a regular basis. For safety awards, not more than 10% of all employees can be entitled to this, and the employee must be full-time with at least 1 year of service. Managers, professionals, administrative, and clerical employees are not eligible for this. The length of service qualifications are, it must be a tangible property given, and it must be presented in a meaningful ceremony. It doesn't have to be anything fancy, but it's just not going up to the employee's desk and saying congratulations and handing them this item. Get your office group together and present it to that employee at that time. And one other thing, it has to be done in the first 5 years of employment and then every 5 years from there. So say 5, 10, 15 years. Okay, personal use of a company vehicle. If you offer an employee a company vehicle to drive, the business use of that vehicle can be excluded from the employee's income. But any miles that are driven for personal use is considered taxable wages to the employee and needs to be added onto their W-2. This would include daily commutes to and from work. If the employee runs a few errands after work, all these would be considered personal use. Employers can elect to withhold federal income tax, but at the minimum, they must withhold Social Security and Medicare. The record keeping of this is left up to the employee and not on the employer. If the employee would fail to do this, keep the good records, and they can't supply it in case of an audit, it would become 100% taxable to the employee. So let's look at the 3 different kind of calculation methods that there are for personal use of a company vehicle. Our first one is commuting value method. This method, you value the employee's personal use by $1.50 for one-way commute or $3 per round trip if the following conditions are met. The vehicle is owned or leased by the employer. The employer, for non-compensatory business reasons, requires the employee to commute to and from work in the vehicle. The employer has a written policy prohibiting the employee from using the vehicle for personal reasons. And the employee is not a control employee. So if you meet all those, then you could potentially use the commuting value method. The second method is the annual lease valuation method. This is probably the most common one used, as it doesn't have the requirements like the other 2 do. For this one method, you determine the fair market value of the car and then the IRS annual lease value table for the calculations. You will then calculate the percentage of personal miles driven for the year, and then you will use to calculate the value of the employee's personal use. If the employer pays for the gas, then 5.5 cents can be added on for each personal mile driven. And finally, our third one is the cents per mile valuation. Currently, the mileage rate is 57.5 cents per mile for 2020. The rate for 2021 has not been released yet. This usually tends to come out sometime in December, so look for that in the next coming month. In order to use this method, there are a couple of conditions that must be met. 1, the vehicle must be driven at least 10,000 miles annually, and the fair market value of the vehicle when first put into use cannot exceed the luxury car value, which at this time, the luxury car value is at $50,400. This has been an increase from what it has been previously in previous years, where I think it was back down to like 15,000. So it has kind of brought it up to more realistic of what a luxury car value is at. Group term life insurance. Employer provided group term life insurance valued at $50,000 or less is a tax-free benefit to your employees if it's provided in a non-discriminatory fashion. Anything in excess of this $50,000, less any employee after-tax payroll deductions, is taxable income to the employee. It is based off of the employee's age as of December 31st of the current year. If you offer dependent group term life insurance, any value over $2,000, the entire amount is taxable. You don't get to exclude the first $2,000. For it to be non-taxable to the employee, the beneficiary of the policy has to be the company, a charitable organization, or it is a termed employee due to permanent disability. So like I said before, the coverage less than $50,000 is non-taxable, and for dependent coverage, anything less than $2,000 is not taxable. It is subject to federal and FICA taxes, but you are not required to withhold federal tax. It is exempt from federal unemployment, and it gets reported on the W-2 in box 12 with the code C. And so here's the uniform premium table that's used off the employee's age and the cost used in the calculation. So on the slide here, you see that what the formula is. You have your group term coverage minus your $50,000 that's tax-free times the 0.001, and then times your group term life cost factor from the table above. And then you're going to subtract off any employee after-tax deductions for the group term life insurance, and this will give you your taxable dollar amount for the monthly premium value. You only need to add this on at year end, and we've had things come up where employees term throughout the year and that they have had this benefit, and if they do not get added on to their final paycheck, you'll have to remember to add it on at year end, and potentially then they won't have any offsetting wages to put this benefit on, so that you'd have to gross it up and the employer would be paying for the taxes on this. Supplemental tax rates. Currently, the supplemental tax rates for the federal rate is at 22%. It does jump up to 37% for wages paid for over $1 million. Supplemental tax rates can vary from state to state. So if you have your state has income tax, you will want to make sure and check for that rate. And things that you would use your supplemental tax rate for would be any kind of bonuses that you want to do, your year-end taxable fringe benefits, or some examples you'd use the supplemental tax rates for. Grossing up your wages. This is used for when an employer is going to pay the taxes on the taxable value of the fringe benefit. The formula you can see there is 100% minus the employee's taxes equals your taxable income. So for example, you have your 100%, you're going to subtract off your 22%, which is your federal supplemental rate, subtracting off your Social Security at 6.2 and your Medicare at 1.45% to equal that 70.35%. And again, you're going to want to watch if your state has income tax, that percentage would need to be factored into this formula as well to properly gross it up to include state income tax. And you also will need to watch if the employee is over the Social Security wage limit or if they're a Medicare high earner, as this formula will change. So here's a couple of different examples of gross up calculations with versus an employee paid taxes on an employee receives a $100 gift card. On the left, we have an example, the employer pays the taxes. You're going to use that calculation. We're going to take the $100 gift card and we're going to divide it by that 70.35%, which we showed you in the formula on the previous slide. This will give you the gross up wages of $142.15. And then you can go ahead and check your math based off of the percentages used for the tax withheld. And then you should be able to net your $100 that you initially started with. The example on the right is when the employee pays the taxes on the $100 gift card, you want to make sure you have wages to add to this. You have your gross of $100 and it gets tax on it, and then you have to have an offsetting deduction of $100 because you don't want the employee to end up with that $100 back in their net check. Otherwise, if you don't have that offsetting, you will also end up with a negative check. Just a reminder on due dates for 2021, the employees' W-2s are due to the employees on February 1st because January 31st is on a weekend in 2021. And they are also, the W-2s are also due to the Social Security Administration on February 1st. And a reminder, if you have 250 or more forms, you are required to e-file those. And then also the 8922 form, which is your third-party recap form, this is due to the IRS on March 1st. IRS scams. So this is something that it continues to be on the rise. It seems like more and more every year. Same people, businesses, public schools, universities, and tribes are the ones that seem to be targeted the most. People are receiving these scam emails. The email looks like it's coming from someone within your company. The email address looks exactly like your company's. The signature line can be identical. You know, if you have your pictures on an email, it looks like it's coming from your CEO with their picture on it, so it can easily confuse somebody. You know, some of the examples that of these scam emails, the CEO of your company emails requesting you to send a copy of the W-2 forms in a specific format for 2020. Well, and it turns out that when you send that, then it becomes that all that personal information on your W-2s goes to the scammer. Or one that we've actually seen or had employers, you know, reach out to us and say, you know, I think I've fallen for this, is they have an employee that wants to request a change in their direct deposit banking information. Well, then the new bank information is just going directly to the scammer, so then that employee would technically be out of their paycheck. Like I said, many people have fallen for these scams, which has resulted in a lot of money getting into the scammer's hands. But if you should fall victim to one of these scams, it's important that you notify the IRS, state tax agencies, local law enforcement officials, as well as your employees to let them know what has happened potentially with their personal information getting out, lost paychecks going to the wrong person. So in the end, if you're ever in doubt, double check with the person that sent the email, either in person or a phone call, to make sure that the request you received is actually legit, and don't respond back to the email that you had originally got from the scammer. And then finally, we just want to touch base here on some state changes. Like Angie had mentioned, we normally don't, you know, touch base on a lot of the state changes, but we just want to kind of throw out some questions here to make sure that you're ready for 2021. So before you run your first payroll of 2021, make sure you update the state unemployment wage base if your payroll system does not automatically do this. And then you want to make sure and update your employer rate for the year so that your accruals start off the year correctly. Minimum wage increases, make sure and look at your states, the different states that you're in, because a lot of states have their own minimum wage rates, and these usually see an increase each year. You want to make sure and keep up to date on these changes, because if you pay the rate that is more you have to pay the rate that is more favorable to the employee. So if your rate for minimum wage is higher than the federal minimum wage, you must pay the state minimum wage. State W-4 forms, does your state have a separate W-4 form, or does it follow the federal W-4 form? I know we're located here in Minnesota, and Minnesota did not configure to the federal W-4, so now employees hired in Minnesota have to fill out a federal 2020 W-4 form as well as a Minnesota state W-4 form, because our state still is based off of allowances, unlike the federal. Now, cities, county, school district tax rate changes. We're seeing more and more local taxes within a state, whether it be the city, the county, a school district, or it could be a combination of all three. So make sure and look to see if these local tax rates are changing before you process your first payroll of the year. Does the state that you have employees in offer disability? Right now, there are a handful of states that do offer this. The thing to look for is who pays for this. Does the employee with a payroll deduction out of their check, or is it employer paid, or possibly a combination of both? Does the state that you have employees offer paid family leave? Again, look to see who is paying for this leave. Does your state offer mandatory sick leave? It seems like more and more each year, there's more states added to the list that has this requirement. So make sure and check to see if your state has the state mandated leave. And then know the filing deadlines for any annual returns that need to be filed. You know, are they due January 31st or perhaps an earlier date? And then finally, what are the state filing deadlines for W-2 forms in the states you have employees in? These can vary from state to state. Another item is to look at, is the filing requirement? Do you have to be done electronically versus paper copies being mailed in? And so that ends my section with the taxable fringe benefits, and I'm going to turn it over to Jillian now so she can discuss the 1099s.
Thanks, Kate. Looks like I have control. Awesome. So I am going to just run through these quick things here in the last 30 or so minutes that we have. So we'll talk about 2020 changes, kind of hit on that new NEC form, go over some due dates and penalties, filing basics, just an update on backup withholding, review some correction items, and then go into some tips for filing forms. So let's get started. That did not advance. Okay, there we go. All right, so for 2020, kind of along the same lines as Kate was talking a few minutes ago with fraud and scammers and such, the PATH Act of 2015 was created to protect people from fraud. And as part of that, they changed the due dates for W-2s and 1099 miscellaneous with non-employee compensation to be due at the end of January to the IRS. Also, they've always been due to the recipient by that date, but to the IRS. So that's kind of caused an issue over the last couple years where we've had this miscellaneous form that had basically 2 due dates to the IRS. And then if you filed the whole set of forms late, you would get penalties on maybe more of the forms than were actually late based on how kind of confusing and hard that was with the 2 due dates for the same form. So the 1099 NEC was created or recreated, it actually was around a long time ago, in order to make that simpler by having all of the information due earlier was on this NEC form, and the stuff that was due later to the IRS is on the miscellaneous form. So hopefully that's helpful. The problem is that we have software to change, reporting to change, and that kind of thing to be able to cover that separate form. Another update for 2020 is that the forms are generally due January 31st and February 28th, but both of those days this year are Sundays. So that pushes any due dates that were January 31st to February 1st and any due dates that were February 28th to March 1st, just as an FYI. And then the backup withholding percentage is still at 24%. And I have heard that the IRS is working on increasing the task force that will reconcile 945s to 1099s and the other forms that have backup withholding to make sure the amounts that are showing as withheld on all those forms are actually being withheld and paid to the IRS. So maybe watch for more activity there. So a little bit on the NEC form versus the miscellaneous form. So this is the new 2020 1099 NEC form, and that left-hand side is the same basic information as on the 1099 miscellaneous form.
But then on the right-hand side there, we basically got two boxes, one non-employee compensation. So anything that you would have reported in box 7 on the miscellaneous form will now be in that box 1 form. And then box 4, because several boxes use federal income tax withholding as box 4, they have put box 4 there for that form instead of using box 2 just to be consistent across the forms. And then they also have 2 and 3 reserved for possible future use. And then the states will be down there on the bottom. So this form will be due electronically filed, paper filed to the IRS on the 31st of January, except for this year, it'll be February 1. And then obviously also to the recipient by the 31st of January. And then the miscellaneous looks similar as it did before. So this is the 2020 1099 miss form. And again, the left is the same. And then we just have a few box changes. So box 7, which used to be the non-employee comp box, is now payer made direct sales of $5,000 or more. And then box 9 is now crop insurance proceeds. 10 is gross proceeds paid to an attorney. And then 12 became 409A deferrals and 14 non-qualified deferred compensation. So no huge changes on these, just kind of moving the boxes around. So when you're in your software, if you do use software for this purpose, just double check that you've kind of rearranged those forms so that your software has an update that will handle those changes. We're going to jump into the due dates here, and I've kind of already talked about them because they're informative or, changing for 2020. But the NEC box right there, you can see I circled it, is due January 31st, electronic filing, paper filing, and recipient copy. You guys have the presentation slides here, so this is just kind of a good chart. I thought I'd throw in the materials for basic due dates for this in a year. Obviously, we changed January 31st to February 1st for 2020. And then just wanted to talk quickly about penalties, and these penalties are the same for the W-2 information returns. So these charts I have apply to both 1099s and W-2s. But there's basically 2 types of penalties with respect to information returns, and you're penalized for not completing a form when it's required, or filing it by the due date, not completing the return with the appropriate info, having a missing taxpayer identification number, or typing it in wrong or having the wrong one. Sometimes you'll be penalized if you have a social and you have a business name, or you have a federal ID number and you have a personal name. We need to make sure all those things agree. So there's the 2 types, 6721 and 6722. The differences really aren't important. The penalties are the same for both, and that's what's shown on this screen here. So I am showing the large business one here. So that's over $5 million in the most recent 3 years. And I have the chart going back a few years here just as informational. They tend to increase a bit in that maximum amount for inflation. And then what's key on this slide is the intentional regard has no maximum. So it's important to at least attempt to file a form. If it's late, it may be $280 per form, but if you intentionally disregard to do it, it's $560 per form, and that could go millions of dollars worth. Here's the small business slide, which is less than 5 million gross receipts average of the most recent 3 years. The rates are similar, it's just those maximums are less. And again, you guys should have these slides, although I just noticed some chatter about maybe missing some slides. So it looks like we'll be getting an updated one out in an email. But this information is just so that you have it handy. If you filed more than 30 days late, you can just, or not more than 30 days late, excuse me, you can just expect $50 of a penalty there. So just to review some filing basics, who needs to file? A payer that is taking that deduction on their books would need to file, and only if you're making this payment in the course of your trade or business, so not anything personal. And payers do include entities that don't pay tax, so tax exempt type entities. They would qualify as payers, so they would need to file forms. Another kind of random situation where you would need to file a form is if you received a 1099 that had maybe more than the income that belonged to you, or one that didn't belong to you, you should file a 1099 to the person that actually does belong to. The example I hear recently, or most frequently on this, is a group of brothers or something owns some farmland that their parents gave them, and the one brother gets the 1099 for all of the income earned. That brother can then turn around and do 3 or so 1099s to the other brothers to split that income out so they don't have to report the entire income amount on their tax return. And then successor and predecessor reporting is important when two entities merge together or one buys another. The entity that is in the end could do the reporting for the whole year if they both decide on doing that. So for example, a bank purchases another bank. The original bank could do their 1099s through June if that's when they merged, or they could have the bank that purchased all of them do the 1099s for the whole year. So that's just a conversation that needs to happen between the entities. And then who needs to receive a form? Sole proprietors, partnerships, LLPs, and then LLCs depend on if the company is being taxed as a corporation or not. So definitely get a W-9. There are also some exceptions for when a corporation does need to get a 1099. So just pay attention to those exceptions as well. And then who does not need to receive a form? Generally a corporation. And so I have the exceptions listed here. Attorney's fees and medical payments are generally the two areas where a corporation will need to receive a 1099. And tax exempt entities don't need to receive. And then again, the LLC depends on the type. So just get a W-9 to be safe so that you have that in your file and you can prove that they told you they were a corp and that is why you did not file the form. All right, so basics on the general filing requirements, and this is not all inclusive. These are just the ones that we see the most of, so I thought I'd highlight them here, but $10 or more in royalties, interest, dividends, or retirement plan distributions, and then $600 or more in rents, services, prizes, medical, and healthcare. Again, that's a box that we need to send to corporations, crop insurance payments, and then other, which is a whole, you know, that could include several things. $5,000 or more in direct sales to consumers, $20,000 or more, and $200 or 200 transactions or more to through a third-party payment card transaction, so like a PayPal, credit card, that kind of thing. And then any amount, doesn't matter the amount if you did withholding. A little bit on paper filing. So you're required to e-file if you have more than 250 forms of each type of form. And that basically means if you have 1099 NEC in the amount of 100 and 1099 miscellaneous in the amount of 300 and you have 400 total, you need to file the miscellaneous by electronic because it's more than 250 of that form, but you can still file your NEC on paper. And when you are paper filing, these forms are machine read, so they need to be legible. You have to include the 1096 so the IRS can reconcile the number of forms attached to make sure they have everything. They need to be, your handwriting needs to be appropriate if you're going to handwrite versus type. Don't use $ or number signs. That gets confused sometimes for, you know, a 5 or something. And then make sure you use the red forms when you're sending to the IRS and mail it in a flat envelope so they don't fold and get misread. For electronic filing, you get an extra 30 days usually, or an extra month generally on the filing. So instead of those being due by February 28th or March 1st in 2021, they are actually due March 31st in most cases when you e-file, except for the NEC, which we've talked about a couple million times already, but that one is due February 1st to the IRS and to the recipient paper or electronic filing. And again, with that 250 number, same example, you need to file if you have more than 250 for a specific type of form, and you can, that's filed through the FIRE system. And 1220, publication 1220 provides the detailed information for how to file that. With respect to that file that gets uploaded, a lot of software programs will create that text file that needs to be uploaded for you. So you probably don't have to read the 1220 in detail, but if that's something that you would like to do, that's where that information is at. So this is the form 4419, and this is how you apply to file electronically. I noticed when I was reviewing this slide yesterday, I have 2 dates on there for due dates. So that top 30 days is, ignore that little file 30 days before the due date thing. So you should submit the form by November 1st of the year before filing the information returns to ensure that you get processed in time to be able to file timely. They generally say allow 45 days for processing. So sorry for the double confusion there on this slide. But once you file this, you'll get a TCC code, transmitter control code, and that is what you need to put into the FHIR system in order to file and have those electronic files be part of your filing. You don't need to redo this every year, and you can request to not electronically file even though you hit the 250 by using a form 8508. And that form is effective for 1 year. So the 8508 is an annual form you'd have to request to get the waiver for e-filing. All right, so backup withholding. Backup withholding is generally required if you do not have a taxpayer identification number for someone or you have an incorrect number. And then you've received a notice from the IRS stating that you filed incorrect information and your TIN does not match the payer. So you should start backup withholding when you get that notice unless you contact the person you paid and got an updated taxpayer identification number. So payers who fail to withhold at that time when they realize that they've got an incorrect TIN can be held liable for that withholding tax. And that can become pretty expensive. I've got an example here on this slide. So let's say the payer A paid services recipient B of $20,000 and they never got a W-9. Then they go to try to file their form and they didn't include a TIN and they didn't have backup withholding. So if the IRS calls you on that and says, hey, we should have done backup withholding on this, that would be 24% of that $20,000, which is $4,800. And then there'd be penalties and interest that you would be subject to. So depending on what those penalties and interest are at the time, because they kind of swing with interest rates and such. Let's say it's 10%, that could be an extra $480. And then you would also receive that penalty for not filing timely, which is actually, I think it's $280 now. I forgot to update that $270. So total penalties in this case would be $5,550. And that's just one recipient. So if you had several where you should have been doing backup withholding, then you could get several penalties for this. So just something to be aware of. Again, make sure you get that W-9 and you have that appropriate information. A little bit on 945. This form 945 is similar to the 941 as far as it reports withholding. And so the payment schedule, so you can pay $2,500 or less with this form. If you have more than that, then you have to be depositing similar to how you would deposit with the 941. So $50,000 in a prior year or less, you can deposit that monthly, and you can see on the bottom there, that's kind of your monthly liability schedule. And then if you paid $50,000 or more, then you have to do semi-monthly, which is the similar information to the 941 semi-monthly. And there's another schedule that you could attach there. So any forms you have backup withholding on 1099, you should be reporting that information on this 945, and you should have been making deposits unless you're under $2,500 by the end of the year. This is just the reconciliation to that. All right, so corrections. Sorry, I got the poll pop up. All right, so when you're making corrections, you need to make those corrections as soon as possible. So as soon as you notice something is incorrect, you should make that correction right away. As you saw in that penalty slide, the longer away from the due date you get, the higher the penalty becomes. And then you want to determine what kind of correction you have to make here. And that's just important because a type 1 correction requires one form and a type 2 correction requires 2 forms. I'll talk about those on the next couple slides. And then determine if you're going to be e-filing or paper filing these corrections so that you can gather forms if you need them or figure out how to file a corrected form in your software. So type 1 errors are generally just a one form correction required. And that's usually when the money amount is incorrect. So what you would do is just send in a new box, type corrected, and update the amount. One form is required because that person receiving the form, all of their information was correct. It's just that you need to update the amount. So the process would be update that form, check corrected at the top. If you're going to file by paper, you need to prepare the 1096 and the copy A for the IRS, or you can submit that electronically. Send the corrected form to the recipient so that they know. And then you don't need to attach original forms or anything. That would just confuse the IRS. Only send the corrected. And then the type 2 errors, they're a little more involved because that would be when you've got a goof up in the person who received the form and their information. So you had the wrong taxpayer identification number, for example. You'd have to file a corrected form with the original taxpayer identification number that was wrong, and you'd file that form with a 0 amount. So you'd mark it corrected, you'd file that form with a 0 amount. Then you need to file a second form that's not corrected, because that's going to be kind of the original form for that taxpayer identification number. And then you can include a phrase at the bottom that would say, you know, filed to correct TIN, filed to correct name and address, etc. Same process here. If you're going to handwrite the form or print the form and mail it in, you would need to prepare a 1096 and the copy A for the IRS. And then you send that corrected amount to the recipient. All right, so just going to go through some tips here on making your filing season easier. And obviously, I've said this a few times, but make sure you get that W-9. And a really good way to handle that is to ask for the W-9 before you make your first payment to someone, just because then you're kind of withholding their payment in a sense until they give you that appropriate information. You can also send an annual letter with maybe the first payment of the year requesting an updated W-9. That's not required, but sometimes it's good practice if, depending on the businesses you're in, your vendors can change a lot, or maybe they're changing their business types, or you know, just always getting an updated W-9 is a good idea in certain cases. If you've always dealt with the same people and they're very, you know, there's not a lot of changes, then you wouldn't necessarily need to do that annual letter. And then using a TIN verification program is a good idea. It doesn't really tell you much of anything except for this social doesn't agree to this name. So then you would know at that point to go back to that person and say, hey, this didn't match. Those are free through the IRS website, or a lot of software programs that can be used to prepare the 1099s will have an option to use their TIN verification program. Another little thing you can use to have less 1099s would be to pay corporations. And that's not always plausible either, but most of the time corporations are not required to have a 1099 sent to them, except for in those few exceptions. So using more corporations would mean less 1099s. And then if you pay vendors with a credit card or PayPal or another third-party payment system, a lot of times those will qualify for a 1099K. And so then the 1099 NEC wouldn't be required, because you're going to be paying them with that credit card, and they would be in the qualification to get that 1099K. So the rules for the 1099K though are $20,000 or more and 200 transactions. So it could be that they won't get a 1099K, but because you paid them with a credit card, you don't need to send them a 1099 NEC, because there's a possibility they would get that income reported on both 1099K and 1099 NEC in that case. All right, so I just wanted to show you, since I mentioned W-9 a bunch of times today, what that form looks like. It asks for the name of the person you're paying, and if there's a business name, and then it'll ask what type of entity they are. And if they're an LLC, it asks them to confirm whether they're a partnership, a corporation, or what they are, so that you can be sure that you have the appropriate information. And then address, that kind of thing, and their social security number or employer identification number. So if you're the person in your entity that would receive or request these W-9 forms, it's a really good idea to quickly look at them when you get them. And that's because if for some reason someone gave you their name and then they gave you like John Smith, and then they gave you a federal ID number or employer identification number, sorry, you'll just know right away that's not going to work. The IRS is going to not accept that, because it's not going to match in the TIN program. So then you could call this guy right away as soon as you got that information and say, hey, I see that you gave me an employer identification number. Can you please give me your business name? You can also review it right away to see, so they checked limited liability company, great, but then they didn't fill out that little box letting you know what kind of tax classification they are. So then you could call them back right away and say, hey, you forgot to fill this part out. So if you look at these when you get them, and kind of review them right away, it's a lot easier to follow up versus a year down the road, January next year, we're trying to file the 1099s and you don't even know if this person, you haven't written a check to them in a while and you don't know where this person is anymore, you can't get a hold of them, etc. So if you're the W-9 person, reviewing these as you get them is a great idea. And then this is just a screenshot from the IRS website showing you the taxpayer identification number, or the TIN matching program. So you can just apply there and you kind of go through some steps to get authorized, and then you can do the TIN matching. Like I said, it is very much like, okay, John Smith doesn't agree to this social. that's all you know, but that's pretty much enough to then call them back and say, hey, what is your actual social, because this didn't work in the system. And if you don't get a new number from that person because you know the TIN doesn't match, you should be doing backup withholding. Another awesome thing that you can do to make your filing season easier is use your accounting software. Like QuickBooks Online Desktop, Sage Intacct, several programs, others too. There's a lot of accounting programs, but they generally will have vendor details. And in those vendor details, you can fill in all the information, such as the social security number, the address, what type of vendor they are. So that would even be what box they should get information on. So if it's a independent contractor versus the renter, there's lots of information you can fill out in those software programs to allow you to easily prepare your Form 1099s at the end of the year. So I would suggest updating that, filling those out all year long. Then maybe quarterly or as often as you have a few minutes, which nobody seems to anymore, but if you have a few minutes quarterly, run a report that would show you maybe anybody you're over $600 for, or anybody that you have issued a 1099 to in the past, or however you want to run that report. But then you can review that report frequently and see what information you're missing. So let's say you don't have a zip code on someone. You can look up that zip code at that time versus waiting until January and having to be stressed out and looking for it. Or you can request W-9 data if you know that you don't have the social in your system. And then you can also connect most software programs with online platforms that will assist you with filing. So like I think built into QuickBooks Online, sort of built in, it's like an add-on, but you can select a box and it will connect your software to their software, the 1099 filing software. And as long as you fill out all the information within the system, it will basically prepare those 1099 forms for you. Those generally cost money, but it's, you know, worth your investment if you save a bunch of time with paper filing, ordering forms, mailing, and all of those things, especially in this, you know, day and age where most people are at home and trying to get their work done. So check into your software and what maybe online platforms for filing 1099 it will connect to. And then just kind of to wrap up here with some common errors, most of these are related to paper filing. But some of them aren't. So not filing a form when one is needed, or filing a form late, filing the wrong form, meaning you needed to do an NEC maybe, but you filed it on a miscellaneous, or putting it in the wrong box. So maybe someone paid you rent and then you put it in box 3 on miscellaneous instead of box 1. So just making sure you're paying attention to where those amounts go. And in your accounting software, there might be options to correctly code those, or it will pull from the chart of account that you posted that activity to. So just making sure in your accounting system too that those are mapped to the appropriate areas. And then if you don't report a taxpayer identification number, or you report an incorrect one, then that's a common error as well. When you paper file, you must file that Form 1096. So not filing that form is a common error. And then if you are going to paper file, you know, not using cents or including the wrong amount, not using appropriately dark ink to be machine read, not filling out the form in illegible way, too big, too small, or maybe using improper formatting of a name of someone or their address. So to kind of close here, it looks like we might have an extra minute or two, which is great because I can review some of the questions that have been coming through. But this is our year-end website, and it's at eidebailly.com/I'd-like/year-end. And on this page, we have our 1099 and W-2 ebooks. And so these are a downloadable book. We've kind of simplified the IRS instructions into just some real basic data. If you need more data than what's in those books, you'll have to review the instructions, but we tried to make it a little bit more easy to read. We've also included things in there such as due dates and penalty and correction information. So just some data in there that's helpful when you're preparing forms. And then also on this site, there is just other resources, insights we've written with respect to certain questions. So check out this page. You also should have our email addresses from the slides. So check in with us if you have additional questions, and I will look through these Q&As and turn it back over to Amy. Thanks, everyone.